Hey guys, welcome for another video. My name is Paris and today's topic is gonna be the differences between centralized and decentralized exchanges. So with the recent kind of fall of FTX, I thought it would be important to learn for myself and also to share it on my YouTube channel. What are the main differences between a centralized and decentralized exchange, how a decentralized exchange works, and also the risk that it has. So yeah, let's jump into it. So to begin with, we're gonna talk about kind of the main differences between centralized and decentralized exchanges. And for that I have created a table which you will be able to see shortly, and we're gonna go through kind of the main differences. Before I begin, I want to say that some of the points are kind of simplified, and in some cases they are not 100% accurate. So please take them with a grain of salt because there are exceptions to what I'm gonna talk about. So, starting with the general idea, a decentralized exchange is normally slower and more complex, unregulated, no KYC, and you can only trade cryptocurrencies. On the centralized exchange, it's generally faster, easier UX, it's regulated and offers fiat currencies as well. Now, regarding deposits, you cannot directly deposit money on a decentralized exchange. Again, the exceptions is MetaMask that has a third-party card processor, MoonPay, and then also 1inch. It has also a card processor as well that you can deposit your money directly. On a centralized exchange, you can directly deposit money, but then again, that's not always true because some banks are not crypto friendly and they won't allow you to deposit money. From a control perspective, in a decentralized exchange, you have full control of your money. On a centralized exchange, the exchange controls your money, so it's not your money. And that's kind of the motto as well that you have, if not your keys, not your money. From a security perspective, basically in a decentralized exchange, and we're gonna see this a bit later on as well, you have the smart contract exploitation. So a recent example would be the Mango, and it was a market manipulation. From a crypto.com report, they talk about three main security points. They talk about price manipulation, re-entrancy attack, and a rug pull. From a centralized exchange, you have hacks, bankruptcy, and business misconduct, as we have seen with FTX. Regarding fees, normally on a decentralized exchange you have lower fees, on a centralized exchange you have higher fees. Again, both of these statements are not 100% true all the time. On a decentralized exchange you have more variety, anyone can create a new liquidity pool, but it depends on the tokens. On a decentralized exchange, regarding variety, you have more coins as long as there's a liquidity pool between the two pairs that you want to trade. On a centralized exchange, you have less variety due to the exchange's security criteria. They don't allow any token to trade on their exchanges. Regarding the risks, you have liquidity pool issues and what is called impairment loss. And on a centralized exchange, you give up custody of your money, and therefore that can have a risk. As we have seen again with FTX, millions of people have lost millions of dollars because they're locked. Regulation-wise, on a decentralized exchange, it's not regulated. It's quite difficult to regulate it, as it's only a platform with no central control. And a centralized exchange, of course, it is regulated, especially in developed countries like the US, and Europe. You do need to get permission. And finally, regarding liquidity, in a decentralized exchange you have lower liquidity, and in a centralized exchange you would have high liquidity. Again, it's not always true. So for example, I have talked about Woo Network, and they're a deep liquidity platform, and they have a centralized and decentralized platform as well. So those were the main differences between a centralized and a decentralized exchange. Now we're gonna see how a decentralized exchange works, the definition of it, and also then we're gonna go through the risks. So a decentralized exchange is an alternative to centralized exchange in which no single entity is in charge of the assets. A decentralized exchange uses smart contracts and decentralized apps to automate transactions and trades. And basically, a DEX is a peer-to-peer marketplace where transactions occur directly between crypto traders. DEXs fulfill one of crypto's core possibilities, fostering financial transactions that are not officiated by banks, brokers, or payment processors. All these transactions are handled by the exchange itself via order book, and we're going to talk about what order book means, and that establishes the price of a particular cryptocurrency based on current buy and sell orders, the same method used by stock exchange as the New York Stock Exchange and also Nasdaq. Finally, decentralized exchanges are simply a set of smart contracts. They establish the prices of various cryptocurrencies against each algorithmically and use liquidity pools in which investors lock funds in exchange of interest-like rewards to facilitate the orders. So this in summary is what a decentralized exchange is, right? So it's a peer-to-peer trading platform that there's no one in control of it. So in that sense, if you make a mistake, there is not going to be any customer support to help you. So that's very important. You do have, this is why on kind of the table I showed before, it says that it's more complex, because one mistake and that's it, your money is kind of lost, to be honest. Now we're going to talk how the decentralized exchange works. So what they use is an automated market maker method, and basically it's a pool of funds or else liquidity pool, as we saw earlier. So basically algorithmically through a mathematical formula they set the prices of the cryptocurrencies, and that's pretty much it, right? But let's talk in detail as well, okay? So liquidity in terms of trading refers to how easily an asset can be bought or sold. High liquidity suggests that the market is active and there's a lot of traders buying and selling a particular asset. And vice versa, low liquidity means that there's less activity and it's harder to buy or sell an asset. Okay, and that's why also liquidity is a key feature for any decentralized exchange. As long as there's high liquidity, then people are gonna use it, because for a trader it's very important for the pair that they're trading to have high liquidity. So trading pairs you would normally find on a centralized exchange exist as individual liquidity pools in AMMs. For example, if you want to trade ETH for Tether, you would need to find an ETH and USDT liquidity pool. So the difference is that in a centralized exchange, the market maker is the exchange itself. The exchange provides the liquidity for traders to exchange. The difference is that in a decentralized exchange, anyone can be the liquidity. Anyone can stake and put money into a liquidity pool and earn rewards out of it, and we're going to talk about that as well soon. So anyone can provide liquidity to these pools by depositing both assets represented in the pool. For example, if you wanted to become a liquidity provider for ETH and USDT pool, you would need to deposit a certain predetermined ratio of ETH and USDT. And the keyword here is the predetermined ratio, because basically one ETH, let's say it's $1,000, then of course you would have to have at least 1,000 USDT as well in the pool, because you have to have a ratio which is balanced. These protocols use smart contracts, self-executing computer programs, as we know, to define the price of digital assets and provide liquidity. In essence, users are not technically trading against counterparties. Instead, they're trading against the liquidity locked inside these smart contracts. These smart contracts are often called as well liquidity pools. So the AAM automated market maker is a smart contract, and also as an umbrella is the liquidity pool. When ETH is purchased by traders, they add USDT to the pool and remove ETH out of it. This causes the amount of ETH in the pool to fall, which in turn causes the price of ETH to increase in order to fulfill the balancing effect of X multiplied by Y equals K. So that is a simple mathematical formula that exchanges use. Of course, there are more complicated, to be honest, formulas, but it is a formula that they use to balance the price of a crypto asset. Okay, and I do have on the link below a few websites that you can go and check these mathematical formulas. As for automated market makers, any person can become a liquidity provider as long as they meet the criteria hardcore at the smart contract. So that means that they need to provide a specific ratio of a liquidity pool. And in order to incentivize people to add to a liquidity pool, they provide rewards. The protocol rewards liquidity providers, or LPs, with a fraction of the fees paid on transactions executed on the pool. So basically how a decentralized exchange makes money is by the fees that they charge, a small amount per fee that you do, right? And that's important because basically that small fee that you pay as a trader to trade on a decentralized exchange, that goes to the liquidity provider that has locked their funds for you to trade. So it's like you have the trader, you have the liquidity provider, and it's just a balance. You have to have these two people, and the decentralized exchange is just the platform where these two people can coexist, if that makes sense. One trades and one kind of gets the rewards of another person. So as an example, the leading decentralized exchange Uniswap is in 2021, late 2021, was charging a 0.05% transaction fee on the 100,000 trade sampled by global accountancy firm KPMG. Centralized exchanges like Binance, Coinbase and Kraken were charging 0.1, 0.2 and 0.2 respectively, and that is from CoinDesk 2021 article. In general, order book, right, or AMM, is basically what a buyer is willing to pay for a specific token and a seller is willing to sell. Now we have seen how a decentralized exchange works, right? So you have a trader and you have a liquidity provider, right? The liquidity provider puts and locks funds in a liquidity pool, let's say for example ETH with USDT. They deposit a predetermined ratio of ETH and USDT, and then the trader, with every trade that they make, they pay a trading fee, and that fee, part of it, goes to the liquidity provider. And the decentralized exchange is just the platform that these two people meet, and one trades and the other one just provides the liquidity for it, the money. Now what we're gonna talk about is the risks that a decentralized exchange has and how you should protect yourself. According to Crypto.com report, there are three main risks associated with decentralized exchanges. Those are price or oracle manipulation, so that's price manipulation, re-entrancy attack, and a rug pull. Okay, so talking about the price oracle manipulation or a price manipulation, basically it's where attackers manipulate the asset price data on a decentralized exchange such as, let's say, Uniswap, right? If the manipulated exchange is used as the only price feed for a DeFi platform, attackers can buy or sell a certain asset that is below or above the fair market price on the platform. So a recent example of that is the Mango hack. So someone recently manipulated the native token of Mango Markets, which is called Mango, MNGO, as they purchased 438 million Mango tokens, increasing its price, and then borrowed against the same token when it was high, and started buying other cryptocurrencies within the Mango platform. Once the token dropped in price because it couldn't sustain the increase in price, he paid the loan, but then also in the process he had made millions, and if I'm correct, he made about 116 million US dollars. There's more to that story, and I'm gonna leave a link below because it's quite an interesting one to read, and it's ridiculous that that can happen as well at the same time. The second risk is re-entrancy attack. So basically you manipulate the smart contract, creating vulnerabilities in the DEX and exploiting that smart contract. As an example, think of a poorly designed ATM machine that only checks your balance once you once you remove your card. So you insert your card, you take out $100, and then another $100, and then another $100, and only once you remove your card, it shows, oh, your balance is minus $300 because maybe you didn't even have money. So that is a tweak in the smart contract, in a poorly written smart contract, and unfortunately it is the exchanges problem there because they have written a poorly designed smart contract, and people who are maybe better smart contract developers and they can write a better smart contract, they can see the vulnerabilities on it and exploit it, unfortunately. And a rug pull is a common rug pull. I don't think I should explain that. I'm sure everyone thank God that I haven't had any experience, but I know, especially 2017, 18, 19, there were a lot of rug pulls and a lot of people lost a lot of money. So guys, that was the video for today. We have learned how a decentralized exchange works, the risk associated with decentralized exchanges, and the main differences between a DEX and a centralized exchange. To kind of tell my opinion, what should you use? Like, should you use a decentralized exchange? Should you use a centralized exchange, right? It comes down to the philosophy, your own personal philosophy. Both have pros and cons, and it's important to know them before you start trading or holding your crypto in an exchange. What you have to ask yourself is that, do you mind if a centralized exchange knows who you are, or do you prefer to be anonymous, right? Do you want to own your assets and know that they're in your wallet, or do you trust a centralized exchange to keep your money safe, right? And a lot of people had their money on FTX, it collapsed, a lot of people won't get their money back. And if you're a trader, one of the most important things will be liquidity. Therefore, a centralized exchange with high liquidity is probably a better choice for you. Or a decentralized exchange, and I think that will be the future, is a decentralized exchange with high liquidity. And I think by the next bull run, whenever it is, if there's going to be one, like 2025, let's say, there will be more decentralized exchanges with high liquidity pools. Where I keep my money is mostly on the native wallet of each token that I have. So for example, VET, I have it on the VThor wallet. Azero, I have it on the Azero wallet, azero.dev, on their platform. Woo token, I have it at Woo platform, and I keep some crypto that I just buy at crypto.com, because that is kind of the platform that my bank allows me to buy my crypto on. So yeah guys, that's pretty much it. All of the research that I have done for this video is on the links down below. So guys, I hope you enjoyed the video today, and next week I'm gonna talk about an interesting topic again. It won't be one of the tokens that I have, but it will be in generally how I'm finding these tokens. So stay tuned, because it's gonna be an interesting one. I shall see you guys next week. Have a good one. Bye bye.